Hello! Today we'll explore one of the most effective strategies with a high win rate, the imbalance formation. In this video, you'll learn how major players leave noticeable traces on charts, often invisible to beginners, and how to use these hints to maximize profits. We'll present a step-by-step action plan and analyze working setups suitable for all types of markets, from cryptocurrencies and stocks to currencies and commodities. Although oil and Bitcoin prices may move differently, the principles of their formation remain the same. You'll see in practice that this strategy truly delivers results. Whether you're just starting out in the world of cryptocurrencies, or you're an experienced trader looking to gain more insider information and be in the right environment, we invite you to join our Telegram channel. There you'll find not only up-to-date news and promising investment projects, but also analytical reviews from experienced traders who share their trades in a free trading chat. Don't wait. Click the link in the description and become part of our community. Now, let's understand what imbalance is. Simply put, it's a gap on the chart occurring between the wicks of 3 consecutive candles, with the color of the candles being irrelevant. In an upward movement, the upper wick of the first candle does not reach the lower wick of the third candle, leaving a space indicating an unexpected market gap. In practice, this means that buyers began acting so actively that sellers couldn't respond in time. As a result, the price spiked sharply, leaving a gap between the wicks of the first and third candles. Such a zone on the chart is where either no trades occurred or their volume was so small that they got lost in the overall background. The main reason for such price imbalances lies in the actions of large participants like banks and investment funds. They enter the market with such large orders that the market can't react quickly enough, leading to a sharp price jump. This shows how the market tries to cope with the suddenly incoming volume. These areas on the chart become strategically important for further analysis. The price often returns to these zones to restore balance and offer a fairer value for both sides of the market, buyers and sellers. Simply put, the market strives for self-regulation. When studying a chart, one of the first steps should be identifying imbalance zones, as they reflect the movements of large capital. Where big money is concentrated, you should be too. Following the actions of institutional players significantly increases the chances of successful trades. To avoid confusion, let's quickly review the key terms related to imbalance. They are most commonly referred to by the acronym FVG, which stands for fair value gap, or simply a gap in fair value. These zones are also sometimes called price inefficiencies. In contrast, effective pricing has no gaps between candle wicks, and the price is distributed evenly, providing fair value for both buyers and sellers. Despite the different names, all these terms describe the same situation, a gap on the chart caused by an imbalance between supply and demand. Now let's examine imbalance from a pricing perspective. Primarily, it acts as a magnet for price. The market typically seeks to return to these areas to restore equilibrium. Additionally, imbalance represents a strong support zone. When the price reaches these levels, a noticeable reaction is expected, after which the market is likely to continue moving in the direction of the current trend. For traders, such zones present excellent opportunities for opening positions. Now let's look at a chart on a smaller time frame. Here, another imbalance can be identified within a larger one. This pattern is quite common. Any price inefficiencies manifest on both larger and smaller time frames. By finding intersections of such zones, you can more accurately determine the level where a price reaction will occur. Repeating all the steps makes it evident that the internal imbalance again acts as a magnet for price and as a support zone from which positions can be considered. It's important that this zone is highlighted because the range between the swing levels below the imbalance has a higher priority for price movement. As is known, higher time frames have a greater impact on the market than lower ones, and this rule is confirmed here. Consider the following situation. Starting from the upper candle, there are active sales by major participants. The selling pressure intensifies to such an extent that it significantly exceeds demand, confirming the formation of imbalance. It can be highlighted on the chart from the low of the previous candle to the high of the next one. This is an early and quite strong signal of the start of a downtrend. The market typically strives to restore the disrupted balance before continuing downward, leading to a decline into the area of the lower imbalance. After restoring this zone, the uptrend gains momentum again. Now let's look at the development of a bearish imbalance scenario. We see a sharp drop in price into the zone of the hourly and 15-minute imbalance. At this stage, the price temporarily pauses, filling the gaps, processing previously unfilled orders. Then the uptrend resumes its movement. The examples you see demonstrate universal laws of price movement applicable across all markets, be it cryptocurrencies, stocks, or commodities. Mastering this concept will allow you to predict major price movements in the future with a high degree of probability. Let's now examine how to correctly identify an imbalance within another imbalance. Here, you'll find a time frame grid useful, which can be adapted to the specific market situation. For example, to refine a monthly imbalance, it's most logical to use weekly and daily time frames. Delving into smaller intervals in such a case doesn't make sense, as it may reduce the effectiveness of the analysis. Apply a similar approach with other frames. Consider an example, refining a monthly imbalance on a daily time frame. This approach not only narrows the potential zone of interest, but also increases forecast accuracy. You minimize risks and increase the likelihood of successful trades. This method allows you to focus on key levels where price reactions are most likely to occur, eliminating the need to chase the chart for a reversal point. Similarly, proceed with other frames. Move to smaller time frames to clarify zones of interest, then use the obtained data for detailed analysis and decision-making. Let's discuss how to choose the most suitable imbalance zones for trading. On the chart, you can often observe that two bearish imbalances form as the price falls. At first glance, they may seem equally important, but the right choice depends on their position in the market context. To assess the potential of each, refer to the concept of premium and discount zones. How to do this? Draw a Fibonacci grid from the high where the fall began to the low where the correction formed. The 0.5 level in this grid represents the balance line, indicating the fair value of the asset. Everything above this line belongs to the premium zone, an area where the asset's price is overvalued. Everything below is the discount zone, where the asset is traded at a lower price. In the premium zone, major players like funds and banks aim to sell their assets at maximum profit before the price declines further. Therefore, the second imbalance, located above the 0.5 level, usually has greater potential for fulfilling its role. It is supported by the actions of large players and is more likely to trigger a price reaction than the first, located in the discount zone. It's important to remember that the market always seeks equilibrium, returning to the 0.5 level, where supply and demand balance out. Ignoring zones in the discount market not only reduces your risks, but also enhances overall trading efficiency by increasing the risk-reward ratio. This approach allows you to focus on more promising trades, ensuring stable results and greater profits over the long term. In a long scenario, the approach is similar, but here we are interested in buying. The most advantageous entry points are in the discount market zone, where assets are traded at undervalued prices. We ignore any imbalance encountered during the correction that is in the premium zone, as the probability of them being fulfilled is extremely low. If an imbalance spans both zones, premium and discount, the situation becomes more interesting. Such cases are common, and the optimal strategy here is to work only with the part located below the 0.5 level. This part becomes our first zone of interest for opening a long position. If the imbalance is deep in the discount zone, it will become our backup point for opening positions if the price does not reverse from the first zone. This approach helps minimize risks and significantly increases the chances of a successful trade. The chart shows how the price sequentially tests the marked zones, bouncing off key levels and forming an uptrend. This clearly demonstrates how correctly identified zones of interest can aid in accurately predicting market movements. Summarizing the premium and discount zones, it is important to note that this approach belongs to conservative strategies. However, it should be considered that sometimes this method may lead to missing some opportunities when the price moves too aggressively and does not return to the fair value level within the correction. Despite this, such an approach provides more stable and predictable results over the long term. If your goal is stability, rather than trying to catch every price movement, this strategy will become your reliable assistant. Now let's move on to the next important stage, creating a simple and effective trading setup based on the imbalance formation. The table we mentioned earlier presents successful combinations of timeframes suitable for analyzing almost any chart. For example, starting with the daily time frame, where the main work is done, you determine the overall market direction, key liquidity pools, and zones of unfilled imbalances. Then switch to a lower time frame, in this case, hourly. Here, the task is to refine the daily imbalances, look for reversal formations, and enter the trade. This sequential and structured plan allows for frequent and highly probable setups based on market logic and the actions of major participants. In the future, we will delve into each of these steps in detail. You'll learn which factors are important before opening a trade, how to correctly choose entry points based on price imbalance, and how to wisely set stop losses and take profits. The first and perhaps most important step is determining the market direction on a higher time frame. This requires analyzing the market structure considering unfilled imbalances and untapped liquidity pools. Consider an example with an uptrend consisting of 5 candles. The key elements to focus on are the latest higher high and higher low. They form the trading range that sets the boundaries for the current correction. It's intriguing to observe a downtrend within an uptrend, a phenomenon you will encounter regularly. Such movements are often initiated by major players to attract liquidity to the market. Buy orders accumulate above each high, and sell orders, removed during the correction, concentrate below each low. These orders are used by large institutional participants to open long positions and increase the asset's value. Support for the trend by major players indicates its strength and relevance. Therefore, the next crucial step is determining the moment when the correction cycle concludes and identifying the target for further growth. Next, it's necessary to highlight key price levels. In our example, these are equal highs and lows. Such levels are artificially created to attract money from less informed traders to the market. These funds are then used by smart money to achieve their goals. From the perspective of smart money, such levels are not just support and resistance from technical analysis, but zones of critical liquidity concentration that will inevitably be breached. Liquidity is the driving force of any market movement. The market moves cyclically, transitioning from one liquidity zone to another, creating patterns observed across all markets and timeframes. To better understand this dynamic, you need to study the concept of internal and external liquidity. This will give you a clear understanding of price movement and its causes. Understanding these processes is the key to stable and profitable trading. Consider a classic uptrend. Its key elements point to areas of external liquidity accumulation, while internal liquidity includes all swings between the current higher low and higher high. The mechanics of an uptrend are quite simple. First, external liquidity related to buys is removed, forming a new high. This reduces the available funds in the market and creates a need for asset redistribution in the opposite direction. During the correction, the market performs two main tasks: removing internal sell liquidity pools and eliminating previous price inefficiencies. These actions encourage traders to open new positions, filling the market with the liquidity needed by major players to continue the initial movement. The cycle concludes with the price moving to a new zone of external liquidity, after which the process repeats. This is a continuous dynamic based on changes in the amount of liquidity in the market. It's important to remember that after external liquidity is taken out, the price tends to move towards internal liquidity and vice versa. This is a cyclical process that can be predicted. Based on this, we can expect the price to move towards internal liquidity pools, followed by a reversal and the asset rising towards external liquidity zones. To refine these forecasts, we add a third step in the analysis, identifying available imbalances that will become zones of interest for opening positions. The first imbalance is in the discount zone and includes key factors that enhance its significance. Above it are internal sell liquidity pools, offering major players an excellent opportunity for active buying at favorable prices before the trend continues. The second imbalance is bearish, formed within the current price range. Its appearance signals the intention of institutions to lower the price even further, which can be used for short-term short positions. The main goal is to return to the first imbalance. The third imbalance is located above the external buy-side liquidity zone. This is the FTA, the first trouble area on the way up, where a price reaction can be expected. Most likely it will lead to a correction during which internal sell liquidity pools will be taken out. Thus, just a few steps allow you to form a plan with a high probability of price movement that will be relevant in the coming days. We expect a rebalancing of the bearish imbalance and consider opening short positions. Within the bullish imbalance, we look for a reversal to open long positions. The goal is to update the last high and reach the area of the third price imbalance, from which we again consider shorts. Next, we will move to a lower time frame and discuss what needs to be done in the zones of interest to increase the likelihood of success. Switching to a lower time frame plays a key role, allowing you to address three important tasks: refining the zone of interest identified on the higher time frame, confirming a reversal, and finding the optimal entry point for the trade. Using the 15-minute time frame as an example, we first refine the previously marked imbalance zones. This helps significantly narrow down the areas of interest where we will expect price reactions. After this, you can adjust the trading plan made on the higher time frame. For example, for a local short position, we target the minute imbalance zone, where a reversal is highly likely and the price will start to decline. The goal in this case will be the beginning of the 15-minute bullish imbalance, which could become a zone for an upward reversal. To confirm a reversal, focus on three main factors: liquidation of buy-side liquidity, a sharp price drop with a break of structure, and the formation of a new bearish imbalance, signaling the start of a downward movement. Even if the structure break doesn't occur, the bearish imbalance itself is a sufficient early reversal signal. In such a case, place a limit order to enter short at the beginning of the zone of interest. A conservative stop loss is set above the last high, and the take profit level is placed at the start of the 15-minute bullish imbalance. Partial profit taking can occur when internal sell-side liquidity is removed. This approach allows for a risk-reward ratio of 1:6, which is an excellent result. In practice, the price often moves between institutional zones of interest, and trades are completed within a few hours. You can choose between two approaches to opening long positions: aggressive and conservative. In the aggressive approach, a limit order is placed at the start of the 15-minute imbalance, and the stop loss is placed below the low of the second candle on the 4-hour time frame. The targets are the nearest previous high and the start of the bearish imbalance. Here, we don't wait for reversal confirmation, but act based on analysis. In the conservative approach, it's advisable to wait for a local structure break and look for a long entry point during the correction. After the reversal and start of the correction, the target becomes the support zone in the discount market. On the 5-minute time frame, zone refinement provides additional precision. Often within an order block, you can spot a small price inefficiency, reaching which signals a reversal and an opportunity to go long. Each order block on lower time frames should include zones of interest, as they trigger price reactions. Successful order block testing involves removing sell-side liquidity, breaking structure in the opposite direction, and forming a new zone of interest for entry. A limit buy order is placed at the start of the imbalance. The stop loss can be set below the nearest low for a more aggressive approach, or beyond the last swing for a more conservative one. Targets are set at levels marked on the higher time frame or locally, such as the last high from which the correction began. Analyzing higher and lower time frames is a powerful tool that allows you to find accurate and effective trading setups. By following these simple steps, you can make more profitable decisions. If you have questions, review the material and write in the comments. We'll definitely help you understand. Remember, before applying any strategy with real money, test it first. This will strengthen your skills, boost your confidence, and positively impact your trading results. Finally, if you want to stay updated on all events and not miss the best opportunities, be sure to subscribe to our Telegram channel. It's your direct access to professional analytics, fresh news, and expert trades, all absolutely free. While others guess where the market will go, you're already taking action, armed with knowledge and strategy. We explain the complicated simply, which is why it's easy to move forward with us. So don't delay, click the link in the description and become part of our crypto family. See you in the chat, and until then, see you in the next video. Good luck and profits.